Hi guys, welcome back to another episode. In this video, I'm going to chat about how to be a disciplined trader. It's all about finding your groove and sticking to your rules. In this guide, we discuss why you need to plan your trading before trading your plan. Think of it like going on a road trip without a map, you'll probably end up lost. This guide is all about why having a trading plan is your secret weapon for success. We'll chat about what your plan should cover, how to stick to it, and why a little forethought can make all the difference. Ready to level up your trading? Let's do this. Discipline is doing what needs to be done, even if you don't want to do it. Discipline is not about perfection, discipline is about continuity. It's more about sticking to your commitments and showing up consistently. Reaching the conclusion that no trade warrants compromising one's principles reflects a commendable level of discipline in trading. Such steadfastness signifies a commitment to ethical standards and personal integrity, which are essential attributes in the financial landscape. By adhering to these principles, an individual not only preserves their authenticity but also enhances their long-term success. Thus, the affirmation "I am a disciplined trader" serves as a powerful reminder of the importance of aligning one's actions with valued convictions. Alright, let's dive into a few things to help you become a disciplined trader. First up, having a trading plan is a must. It's like your roadmap for navigating the markets, it keeps you focused and prevents you from making impulsive decisions. So, if you want to trade smart, start by laying out your plan. A trading plan is not just a list of do's and don'ts, it's the roadmap to trading success. Write out your trading plan step by step and follow it every time. If you don't do this, you won't be consistently profitable in the long term. Never trade on a whim, even if you fear missing out on a big move. I would rather miss out on a big move up because I took the time to develop a plan than jump in without a plan and experience a big move down. Trading plan streamlines your actions. Much like a roadmap, a trading plan outlines your objectives, time frames, strategies, and risk management techniques, and offers a clear path forward. Limits emotional swings. By defining rules and parameters in advance, a trading plan helps to keep emotions in check, limiting impulsive actions that could lead to financial pitfalls. Fosters discipline. Sticking to a plan holds you accountable for your actions and allows you to see where you jump out of your rulebook and into undisciplined FOMO-driven pump-chasing revenge trading. The successful trading plan doesn't exit. Many traders believe that you can be successful by buying and selling random selections of stocks, forex pairs, or commodities. However, the reality is that the most, if not all, successful traders have one thing in common: a well-defined trading plan. When creating a trading plan, some key things you should define are your goals, risk tolerance, and strategies. Make sure to outline what kind of assets you want to trade, your entry and exit points, and how much you're willing to risk on each trade. Don't forget to include rules for monitoring your trades and adapting your plan as needed. Keeping it simple and clear will help you stick to your plan and make better decisions, so remember to include these points in your trading plan: specific market and session, trading strategy, entry rules, stop rules, trailing stop rules, exit rules, risk management, personal rules, journal and checklist. Building the right mindset. Beating yourself up for your mistakes won't help you down the road. It's important to spend the bulk of your time thinking about how to do better in the future. Make a plan that will help you avoid making a similar mistake. Be as detailed as possible but remain flexible since your plan may need to change. Make sure you have it in front of your eyes before open a trade or close it. Whenever you're feeling emotional, just take a step back. Seriously, don't let your feelings dictate your trade. Stick to your system and trade based on the plan you've set, not on a whim or gut feeling. It's all about keeping a cool head and making smart moves, so when emotions run high, just sit it out. Okay, this one is a big one. Not gonna lie, that will take the most time because we are all humans. You will experience FOMO, greed, rage, and so on. That's just normal. That's the biggest reason to start journaling your trades. Write down what you felt. Why did you take a trade that you realize you shouldn't have in the first place? So, in psychology, everyone needs to figure out how she is obviously. Adapt to 3 strikes and you're out rule. Sure. When it comes to trading, the amount of consecutive losses really depends on your backtesting and risk percentage. But since we're human and have our own psychological quirks, it's smart to keep your losses in check. This way, you can avoid falling into the traps of overtrading or revenge trading. Just keep a close eye on those losses, and you'll be in a better spot. Preserving your capital is necessary to stay in the game, so you need to manage risk. No matter how good your charting may be, some of your trades will go against you and will need to get out. That's why I always use stop losses and get out of a trade at a certain predetermined level. Stop losses always limit loss, but do not necessarily limit profit. This in turn allows you to only be right half of the time, or in some cases even less, and still be profitable. Other risk management strategies include limiting the amount of margin you use, only risking a certain percentage of your portfolio on any given trade, and diversifying your portfolio. A key difference between trading and investing is that investing does not, typically, employ stop losses. Long-term investors typically manage risk by using diversification. This topic is something so many of you ignore, and it's one of the most important part of trading. You all heard the sentence, "There is no trading without SL," and some of you may think, yeah, that's not true, but in the risk-reward section you learn how and why this sentence is as true as it gets. You never, ever trade without SL because otherwise you can't calculate your risk. There is also the golden rule: never risk more than 1% of your money, and with an SL you can manage this sentence. Without it, how can you even begin to manage this? You can't. Yes, I know some of you risk 2 to 5%, but not me. I'm a firm believer you should never break this rule. If you risk 1% and lose 10 times in a row, you lost 10%. If your risk reward is 3, you need 4 wins to regain your losses. If you risk 2% and lose 10 times in a row, you lost 20%. If your risk reward is 3, you need 7 wins to regain your losses. You see where this goes, right? Anytime you enter a trade that goes against your trading plan, journal it. This one is very important. Whenever I learn something new about trading, I write it down in a trading notebook. Whenever I make a mistake, I write down what went wrong and what I learned from the mistake. My trading notebook contains my strategies both for bear markets and bull markets, contains the steps for my daily routine, contains my screener criteria, and contains a listing of all the important things I've picked up over the years of trading. Create a list of reasons why you don't want to make the mistake again. Sometimes, it only takes one weak moment to indulge in something you shouldn't. Creating a list of all the reasons why you should stay on track could help you stay self-disciplined, even during the toughest times. Create a list of all the reasons why you shouldn't enter the market. It could be your emotional state, willing to revenge on the market, or might be a price action setup, fundamentals, or something else. It will help to resist the temptation to enter bad trade. While you don't want to dwell on your mistakes, reflecting on them can be productive. Ask yourself a few tough questions. What went wrong? What could I do better next time? What did I learn from this? Write down your responses and you'll see the situation a little more clearly, sometimes from different side. Seeing your answers on paper can help you think more logically about an irrational or emotional experience. So often, we say things like, "It's unfortunate, but market goes opposite me," or "SEC lawsuit crashed prices, so I lose," but blaming other people or minimizing your responsibility isn't helpful to anyone. Before you can learn from your mistakes, you have to accept full responsibility for your role in the outcome. That can be uncomfortable sometimes, but until you can say, "I messed up," you aren't ready to change. This list of good trading rules is nowhere near comprehensive, so please leave a comment below to share your rules and tips for successful trading. Once you have decided that you need discipline in your trading, knowing where to start can be difficult and overwhelming. There are many pieces to a trading plan, and it's easy to feel overwhelmed. You can break the task into manageable sections and master one discipline at a time, or focus on the discipline you need. This approach makes the process more manageable and ensures that each aspect of your trading strategy is given the attention it deserves. With that said, let us know in the comments, do you have a trading plan? What's the most important element of it, and are you always sticking to it?